Hi, everyone. Welcome to today's RAND Remote. I'm Christine Lanoie-Newman, Executive Director, Foundation Relations at RAND. I'm joined remotely by RAND economist Kathryn Edwards, an expert on unemployment insurance, as well as labor market and labor supply issues. Employment and the economy are collateral damages of COVID. I am thankful that I was fortunate enough to have the benefits of creative and flexible work arrangements during this past year. But this was not the case for many people. Without these accommodations, I would have been forced to be un- or underemployed. Like many of us, I was thrust overnight into a new reality of balancing full-time work with the demands of full-time remote learning for my two young children. I know how to be a parent and an employee simultaneously, but I'm not equipped to also contribute as a teacher, counselor, after-school director, and tech support guru. I'm very grateful to have made it to this point with a light at the end of the COVID tunnel and my employment status intact. However, many working parents were among the millions of Americans forced out or pushed out of the workforce as a result of the pandemic. And the cracks in our country's unemployment insurance system have been revealed. Without warning, employment that seemed stable was compromised, and even in cases where people kept their jobs, there were so many work-life challenges and crises that forced people to quit the workforce this year. The past year has made the gaps in our support systems really clear. But where do we go from here? What do we need to do to put people back in jobs and the economy back on track? Through RAND's Tomorrow Demands Today campaign, we aim to rethink and retool these very institutions. Institutions like the unemployment insurance system, which was created in 1935. Our researchers, like Kathryn, are working to find new ways to better meet today's demands. She'll talk more about unemployment and the post-pandemic workforce. Welcome, Kathryn.
Thank you so much. Well, how do you put a labor market decline and something like the pandemic and its effect on the labor market in context? I think this is a very hard question, and one that gets to the personal experience that people have had as they've gone through the pandemic. You know, most people's opinion of this recession will probably be affected by whether or not they lost their job, whether or not they worked from home or had to work on the front lines, or their partner or their children or their parents. And so what I'm hoping to start with today is a little bit of a big picture of where we are and how it compares in this kind of great big nebulous thing called the US economy and labor market. So the figure that I'm showing you here shows a compilation of job loss in every post-World War II recession that the United States has had. Recessions are dated by the National Bureau of Economic Research's Recession Dating Committee, the Business Cycle Dating Committee. And so these all start in month one, the very first month of the recession. So there's a few things that you can get from this graph. What a recession is in the US economy has changed over time. In the early era after World War II, they tended to be pretty short and have a pretty short recovery. So you can see 48, 53, 57, 60, 69, 73. For all of these recessions, you had maybe up to 2 to 4% of jobs lost and a relatively quick recovery of the labor market within 2 years from the recession starting. And there's three outliers of the post-World War II era. The first is in 2001, right? This is the dot-com burst. The economy doesn't lose that many jobs, right? It's a very slow burning recession, but it takes almost 4 years for the economy to recover its employment, even though it never lost that many. It was a very weak and stagnant business cycle. It wasn't associated with really rapid labor market growth. And we didn't have that many months of sustained growth before the next recession in December of 2007 hit. And this one is the one that is in some ways the biggest and kind of most devastating outlier. You can see here the breadth and the depth of the 2007 recession on the US labor market. I mean, it is just months upon months of jobs loss that continues until we've shed 6% of employment. By the time the US has stopped shedding jobs in the last recession, it has completely wiped out almost 10 years of job growth. And it takes over 6 years to recover. Right, and by the time we get to month 77, the economy is back where it started in December of 2007, having wiped out all these prior jobs. So when we talk about the business cycle, I mean, I think a lot of people When they think back to January of 2020, we think about this period of full employment, of unemployment getting to a really low period, but it was preceded by a really brutal recession and recovery that had followed a very weak recession and recovery. And so we were kind of coming on the cusp of 2 decades of the economy not really looking like it had before, and then the pandemic hit. So this is what makes the pandemic recession catastrophic for the labor market. The recession officially starts in February of 2020, and 15% of the jobs that were there in March were gone in April. And you can see this absolute drop, a cliff in employment in the United States in a single month. Over the first 2 months afterwards, we see a really quick bounce back, and then it starts to slowly arch from there. So the questions that we have going forward is, what is the rest of this line going to look like? Is it going to look like the 40s and 50s and 60s? Is it just going to come back within 2 years? Is it going to, drag on slowly for 5 or 6 like it did after the last recession? I think what's something that I think about as a RAND researcher is that none of this is out of our control. The shape of the line and the pace of our recovery is about policy that can determine that. But I guess the last piece of context I'll give you is that we have a system of cash benefits that are supposed to provide targeted, timely, and temporary benefits to unemployed workers, and it had not been reformed meaningfully on the federal level since before these graphs. Since before any of these recessions. I mean, it's basically the same design it's had since 1935, and the last time the federal government had intervened to basically build up the system on the state level was in 1976. And so this is recession after recession of an unemployment insurance system, facing different challenges, facing different labor markets. And April of 2020 was truly historic, and unemployment insurance was not prepared to meet it.
Kathryn, that was really fascinating. Such a great intro. Also kind of terrifying, if I'm being honest. So let me ask you, the pandemic is such we call it unprecedented. It's really this new thing that happens once every 100 years. But as you pointed out, recessions are not new, right? And we have had a lot of them over the past century. Given that, why have we seen Congress have to jump into action and really kind of scramble to stave off this most recent economic hardship? Why did it require unemployment insurance? Why did it require so many emergency changes?
Okay.
Don't get you started, right? No.
Yeah, don't get me started. Unemployment insurance was created in 1935 by the Social Security Act, the same legislation that created aid to families with dependent children and old age insurance, which we commonly refer to as Social Security, the name of the legislation. And I think that they provide a great study in contrast. So Social Security is a federal program. It's also a social insurance program, meaning that it's not means tested. You don't get Social Security if you're poor. You get Social Security if you worked. And how much you get isn't based on your current income. It's based on your past earnings. Right? The same is true for unemployment insurance. You don't get it if you don't have a job. You get it if you've worked previously and you lost your job through no fault of your own. And the amount of money you get is based on how much you earned previously, not how much your family income has to support you. So it's very much in contrast to something like supplemental nutrition assistance. So these two programs are created in 1935. One is run by the federal government and one is run by states. And over the course of the first 20 years, they both expand, but Social Security quickly amends itself to cover more workers and go onto a federal track of having a large trust fund, and workers pay into the tax and not just firms. Unemployment insurance goes the opposite direction. It stays a state-run program, which means that the only tax base and really the only permanent constituency of unemployment insurance are the employers that pay into the tax system. And states decide how much that tax base is, and they decide how much the benefits are, and they decide who is eligible and for how long that they get it. And I bring this up to say that I think there's a natural tendency to judge policy by its date of origination. And, you did not read about Social Security this recession. You do not read about people sleeping outside of Social Security centers trying to sign up. You haven't heard about Social Security being attacked by fraud. You haven't heard about old people getting benefits cut off, but they don't know why, or applying and never getting them. You didn't read anything about Social Security this recession because the program was prepared, because the program is well run and well managed, and it is able to get out benefits quickly. You only read about unemployment insurance because it is administratively very much unprepared. The benefits are not good, and states don't know how to allocate them quickly. So I think that's probably the first important contrast to bring up. I can also talk more about like tax collection history over time if that's what we want to hear about. But I think it's helpful to know it hasn't been reformed, it hasn't been maintained, and it's not a matter of being old, it's a matter of not being basically well stewarded.
Right. That's really interesting. And you're right. I mean, I think people, Social Security is sort of the darling that no one's threatened by and everyone loves, but unemployment has so many, pejorative things associated with it. So given that, what needs to happen to get unemployment insurance right? You said it's not administered well, it's not stewarded, it's not well funded, et cetera. We have a list. How do we fix it?
Yeah, I mean, the answer is the CARES Act. We already know what we need to do. The program needs to be federalized. It needs to have a federal floor. Those benefits need to be administered quickly, and Congress needs to be able to adjust this unemployment insurance system, the benefits and how long they're given when a recession occurs, right? A recession doesn't hit 53 separate states, but Congress's response is contingent on 53 separate unemployment insurance programs. And so if we want to have effective economic response and recovery, we need to have a centralized unemployment insurance system, at least on the worker side, right? That doesn't mean that the federal government has to do everything, but recessions hit the country. And Congress needs to have this. Congress considers unemployment insurance a tool in its arsenal. It's just one that they don't control or finance most of the time. So it's a little bit of a kind of, where do you want the power to tax and create benefits to lie if it's considered central to macroeconomic response?
Right.
Yeah.
Do you think there's a worry? I mean, some of what I've heard is there's a worry that if unemployment benefits are too generous, then unemployed workers won't be incentivized to return to work or to take a job when one is available for them. I'm sure you've heard this too. Can you talk a little bit about that critique?
Sure. I mean, it's not invalid, but it might be over-exaggerated. It definitely was foremost in people's minds in the 1980s when unemployment insurance benefits were then subject to the income tax for the first time. So something that happened, a couple months ago when President Biden was putting forth the American Rescue Plan was that constituency groups were advocating to have unemployment insurance benefit waived from income taxes because most people receiving unemployment insurance had been out of work for a long time and had no idea that they had to pay income taxes on their unemployment insurance benefit. And that was passed in the 80s basically as a way to cut benefits further. But it is a concern, but it's not necessarily a concern that is not subject to context. So if the unemployment rate is 2% and the economy is running at full employment, and I give someone just as much money to not have a job than to have a job, there's no real risk to saying, well, maybe I'll just quit my job and be unemployed for a while, because in theory, I could go find another one very quickly because everybody has jobs right now. The unemployment rate is very low. That's very different when the unemployment rate is above 15%, the highest it's been since the Great Depression, and arguably closer to 20 or 25% based on how it's measured, right? That's very different if I'm staring down a pandemic in which 15% of jobs were erased the month before. A temporary cash benefit that replaces even 100% of my earnings is not a substitute for a job. So there's some researchers at the San Francisco Federal Reserve branch and their research department that have shown the option value of unemployment insurance, the net present value of unemployment insurance benefits relative to a job. And what they point out is that, it's not a decision that you make every week. A job is permanent, a benefit is not. And so even if that benefit is really generous, it doesn't outweigh the value of having a permanent position. One of the reasons why this came up is because the CARES Act added $600 a week to unemployment insurance benefits. And there was kind of initial evidence, or really initial estimates, that this could be, over half of unemployed workers were getting more on unemployment than they did on the job. Mm-hmm. And is what we're seeing really the effect of people not having the incentive to get a job? And I think on a weekly level, sure, I don't need to get a job if I have a benefit, but the incentive is to get a job because the benefit is and did expire, and these benefits don't last forever. So this is why a lot of the conversation about unemployment insurance reform is really about triggers, about making the benefit meet the moment and not be a fixed benefit in time, because it's harder to find a job when unemployment rate is 15%, and we don't need to necessarily starve people out of their homes just to prove how hard it is to get a job. But I wouldn't want 100% replacement when the unemployment rate is 2%, because then it really does change the value of it. So it's given how much these other things matter to people's incentives for job finding, the argument is that the benefit should matter as much as that context should matter as much to the benefit.
Talk to me about women. We're both, as you said, and as I've said, we're both obviously women, working women, and both mothers. And half of the workforce is made up now of women. And we both know, as I'm sure many of our, colleagues, peers, and those watching, that there are different kinds of considerations that have to happen. Typically, although not always, women are primary caregivers to both aging parents to children. There's, sort of more happening there. So does a recession, does workforce issues hit women in a different way? And should unemployment insurance be responsive in a different way for women? Long question, sorry, but I think you know what I'm getting at. Like, there's a woman story here, and I want to hear more about that in terms of employment. Yeah,
well, let's go back to the beginning. In 1950, 30% of U.S. women were working. Mm-hmm. By 2000, it peaks at around 60%. And it increases basically every year until over a 5-decade period, labor force participation among women doubles. This is both historic and incredibly helpful to our economy. Because when you think about the size of the U.S. economy, it is actually very easy to get a number in your head of about how large it is. It is almost a one-for-one mapping of the number of people working. Mm-hmm. So women doubling their labor force participation was an absolute boon to economic growth in the United States after World War II. But it stalls in 2000. And since 2000, we have been basically flatlined in terms of women's labor force participation. We used to be the #1 country in the world in terms of the share of women working, and we've dropped since then. So what is it about the U.S. economy that it both draws women into work but has hit some kind of plateau of how many are working? Well, the U.S. economy is singular in that it does not have guaranteed paid family leave, it does not have guaranteed paid sick leave, it does not have affordable and accessible childcare, and it does not have affordable, accessible, and universal after-school programs. The economics research is pretty clear. If you do anything really between the hours of about 9 and 5 that will put children somewhere safe for less money to the parents, women will work more. Particularly mothers will work more. So they've done this in all kinds of estimates. They've looked at the introduction of kindergarten in the US. They looked at something which I had never heard of, but I guess France didn't have school on Wednesdays for a long time. I had never heard of this, but then they started offering school on Wednesdays and women worked more. So why is it women? Why are women the caregivers? I think it's a very complex, nuanced relationship between couples. But the truth is, the way that the U.S. economy and work support system is designed, someone has to pull back. Mm-hmm. Right, and it doesn't happen in a pandemic. It happens every day, right? There's someone has to be there at childcare at 5:30, no questions asked, cannot be late, right? Someone has to be there when the daycare closes for 2 weeks, because why not, right? Someone has to be there when school gets out early or school is canceled or when someone gets sick. Like, a parent has to be there, and it makes sense within a dual earning couple for one parent to be the caregiving primary and the other one to be the work primary. Mm-hmm. So I've heard people say it's women because women earn less, but that's not a one-way decision. Women could basically kind of pull back early on, right? This is the difference between a female doctor who works at a clinic 6 hours a day versus a female doctor who runs a hospital, right? You might have pulled yourself out of contention for a certain job, not gone up for a promotion, not taken the job that requires more travel because your family needed someone to be home. So the way that I explain it is that women have made sacrifices in inches every day, and the pandemic made that inch about 10 miles long. And we can see that in women's labor force participation and in the declines we've seen. Mm-hmm. So that's caregiving, and that's the caregiving question. And if you go back to thinking about what is the U.S. economy, a reflection of the number of people working, over 2 million women have left the labor force, and it is targeted and appropriate economic policy that this recovery puts women first. Mm-hmm. We have been clipping our own wings in the U.S. economy for decades because we have not invested in working parents and childcare. So, maybe I should just tell you that dads will benefit too, but frankly, all Americans will benefit from a workforce that is growing rapidly and from an economic recovery that is including all workers and not some workers. If you think back to the graphs that I showed you at the beginning, this is one way to change the shape of the line, is to decrease the cost of work for a working parent.
Mm-hmm. Interesting. What about women of color? Is this sort of more exacerbated for these folks?
Yeah. So every recession, labor force participation declines. Mm-hmm. Right? We see this every recession. It's very predictable. And in fact, women actually used to be very well insulated in recessions. I don't know if you guys remember the 2007 recession, but that was actually referred to as the he session or the man session. Both terrible. As terrible as she session. But easier for
easier to say. Yeah.
Yeah. She session just really it's like
literally a ton. Yeah. Make everything harder for women. Let's be honest, right?
But that was concentrated sectorally in construction and manufacturing. So the job loss amongst men was larger. But, there were recessions in the 70s and 80s in which, women saw no decline in employment. Mm-hmm. But that's because women and men don't have the same jobs. Mm-hmm. They don't work in the same occupations and the same industries to the same degree. And I think construction is one that's really easy for people to conceptualize. Most of the construction workers you think of are male. And it is, I think, in miners, extraction. Those are also very male. In every recession, labor force participation declines because in every recession we see some type of job loss. And so what happens is that people lose their job or they're entering the labor force for the first time, and the economy is really bad and it's really hard to find a job. And so they wait. Now, when we think of labor force participation, we think of the difference between, say, a retiree who has no intention of working again and someone who is, desperately trying to find a new job. But in recessions, we start to see this fringe group of people, they apply for jobs, but then they applied for every posting they found on Indeed, and there weren't any new ones, so then they didn't apply for a couple of months. Even though they're still kind of in their own same economic situation, they mechanically fall out of the labor force because the labor force requires constant search. Every 4 weeks is how the Bureau of Labor Statistics defines it. So as people get discouraged in recessions and there's fewer jobs to apply to, you see people kind of falling on the other side of labor force participation. In the first real month of decline in the recession of April of last year, women lost many more jobs than men because they were over-concentrated or they were overrepresented in industrial sectors and occupational sectors that were hit hardest by job loss, like service occupations and leisure and hospitality. But even within those occupations and industries, they lost jobs at a much higher clip. Mm-hmm. So that's problem one. That is a women's story. Yeah. The women of color story is that they don't work in the same jobs as white women. And 30% of Hispanic and Black women work in the service occupations. And the service occupation unemployment rate peaked at 28%. Right? That is a depression. That is higher than what we think the unemployment rate was in the Depression. It was for service workers this summer or last summer. So that's, white women are on average more educated. And so they were more able to telework and maintain their jobs, whereas women of color were more likely to experience job loss. This is, and then we go back to childcare. Who can afford childcare? I mean, I would blush if I actually said how much I have to pay a month to keep my kid in part-time childcare during the pandemic. It is larger than my mortgage by a long shot.
Yeah. And
if you are a single mother, or if you are a mother who makes, say you're a waitress and you make $2.13 an hour, paying everything you have for childcare would not help you afford it. Many women who are lower income rely on their family for childcare, and that became a very dangerous practice during the pandemic, considering that the people providing childcare were in a high-risk group and needed to isolate, right? How do you call your mom and ask her to give you childcare if you have to go into work and you could be giving her the virus? Right? These were very tough choices that a lot of women had to make, and I think it's important to say that that doesn't necessarily feel like a choice at all.
Yeah, fair enough. Thank you for that. I'm still depressed though. Anything, give me some hope. Like tell me that some of what's happening is sort of on the right track, or even that the COVID pandemic has provided a terrible, wonderful natural experiment. So now we have new data that we can, that'll put us forward years in terms of solving some of these problems.
I'll say a couple things. One feature about our labor market is that it can be a pretty ugly place. And the evidence is both mounting and, very, very consistent that people of color are discriminated against in the labor market pretty deeply. So this is done through audit studies where you send out a resume and you keep the resume identical, but you just change the name on the top. And the most famous one of these was called, "Are Emily and Greg more employable than Lakeisha and Jamal?" And they are. They have a 35-point increase in their callback rate for jobs. Now, keep in mind, these resumes are identical down to the character except for the name on the top. But the more black sounding your name, the less likely you are to be called back for a job. That feature of our economy and our labor market, that filters down to workers all the time, right? If you can't find a job, you'll take a worse one. There's a reason why we think that 30% of Black women are in the service occupations, not because they have necessarily a preference for service occupations, but that might have been the only ones because they're the lowest paying that they could get, right? And we see these types of problems in our labor market filter down in both the type of jobs that people get, who loses jobs in recessions and who's able to get them back. Just like the women who have to kind of pass up a promotion or take a different job to be home for childcare, it kind of filters down so that in a pandemic, right, they're the ones that have to quit their job. I think that some of these things might have been hard to convince people were the case a year and a half ago. And I think that the weaknesses that the pandemic revealed in people's lives and the fractured nature of who lost their jobs and how deep was the job loss and what was the effect that it had on families has changed the way that people view this somewhat scorned group of unemployed or low-wage workers. And rather than responding with, paucity, we've responded with an absolutely historic amount of money into the U.S. economy coming through direct intervention into businesses, the unemployed, through unemployment insurance, and through the stimulus checks. I heard on the radio the other day that you could call in, and if you were the sixth caller, you could double your stimmy. I just remember thinking, this is not the world of 2007 or 2008. This was not a world in which we, at the bottom of this figure I showed you earlier, that was when we shut down the government and cut spending kind of automatically, and that our response this time has been, I think because the pandemic is so random and so not the responsibility of the people affected by it, that we are responding with so much more humanity this time of really helping people. And I think that precedent is one that I'm happy about, because recessions happen. People will lose their jobs who worked really, really hard. And It's how much scarring we want to put onto their work lives, how much scarring we want to put onto their family's financial future, and how much scarring we want to put into the U.S. economy of how they're treated when they're out of the job. And so following unemployment insurance and the extension of benefits and the increase in benefits, following this national conversation that, hey, maybe the U.S. workers need sick days. I mean, this is just a different conversation than we had last time. And so I'm hoping that the experience we all have of how terrible this year has been, even if you kept your job, it changes the way we think about, how we want the economy to look for the next 5 years. Do we really want to be 77 months into recovery and just drag through the mud the U.S. economy, or do we really want to bounce back, and are we willing to pay for it?
That was great. I was worried at the beginning of your answer because it was going deeper in the hole, but that really was hopeful. I mean, you're right. We were at this moment of choice. So thank you so much. Anything I haven't asked that you want to share with the folks joining today?
I can talk about tax collection history in the unemployment insurance system. I think what we are not in an era of policy innovation and experimentation in social policy. Mm-hmm. And I would say for me, the turning point is 1996 Personal Responsibility and Work Opportunity Reconciliation Act, PERWORA, if you want to call it that ended cash welfare. So from 1935 to 1996, we had cash entitlement welfare for parents of low-income children, and we ended it. And in the 25 years since, we have seen kind of the fruits of our labor and kind of the stagnation in child poverty. We have continuing disparity between low income and high income children. And I think, there is a question of what did we get for that? Yeah. And I am struck, since I was, 10 when that happened, looking back and reading the legislation and finding that we might not have done much for policy in the 25 years since, but that legislation says of its 4 priorities, 3 of them are getting women married and making sure that there are no out-of-wedlock children, that single mothers find husbands, and that money goes from states to promote marriage. Now, while that might be a beneficial goal in many respects, it did happen. That bill was passed about 3 weeks before the Defense of Marriage Act made it very clear that they were talking about husbands, and that federal policy towards working women and low-income children was get a man. And that was what we put into the legislation. And so it has been 25 years of getting a man, and it's shocking to me that while policy has not innovated much since then, before the American Rescue Plan of last month, I do think that the context of what people expect has changed. And I don't think that you could put into legislation today, women need husbands to the same degree that we did, even in my lifetime in 1996. And I think a lot of people would be, we're ready to move beyond it's women's fault. If you're a single woman, you should probably get a husband. If you're a married woman, you should probably make your husband do more, right? We're moving beyond that to there is some kind of systematic public failing by not having sick days, paid leave, or childcare that is accessible for all women who want to work. And that is something that I think is where innovation is going to come in the next 5 years, is committing to that principle and then seeing how we get to it. Wow. Because I think the key for me is that we didn't have that principle. That was not what we wanted to do. Because if it was what we wanted to do, we wouldn't have put into legislation that single women need husbands. So that is kind of how I think about it in my mind, of how much is going to change in policy innovation now that the scope of what is women's expectations, have changed. Yeah.
Really interesting. I do have one more question, and that is, a lot of what you've talked about has been solutions that come from the government, right? They come from federal policy, they come from the government. If you think about a place like RAND, and if you think about philanthropy, right, what is the role there for philanthropy? Is there a role for philanthropy on this issue? And can you talk a little bit about what that looks like for you? Because there's so much, in terms of the government's responsibility, but where can philanthropy be an engine and a driver for this innovation and for change on this issue?
So there is a question of, I think, how private employers will react to the recession. and to the pandemic and working from home or leaving the labor force because you have kids. I mean, I don't want to be I don't want to be the bearer of bad news, but typically the more your employer finds out about your home life, the more they'll hold it against you. Right. And that is also, I mean, women will be on a permanently lower earnings trajectory as soon as they have their first kid, and they will never recover the average wage growth that they had, I mean, when they were 8 months and 4 weeks pregnant. You have a kid, you will be paid less and have slower growth for the rest of your work career. While no doubt some of that is attributable to women maybe having to pull back in order to take care, there's also a lot of evidence that it comes from firms thinking that women who are now have a child want to work less or are less committed to their jobs or are less productive. So one thing that we've talked about with companies that we're trying to kind of recruit for studies into how women are paid less after children, that another economist at RAND and myself are trying to recruit a corporate partner for, is, you know, you have a truly amazing opportunity here, which is that a fourth of the U.S. economy is at home. You know, you think about corporate culture being entrenched over time. Not many people get a year-long reset button to say, like, okay, this is done, and now you come back. You have a lot of autonomy and agency of how you think about corporate measures of productivity and equality in the workplace now that we're all coming back from being at home. And so the question is, are you going to be proactive about how you incorporate people back to work, or are you going to be reactive about how they worked in the meantime? And so I think to the extent of thinking about corporate partners and private employers, that is the real question, is are they going to adapt to make kind of women and people affected by the pandemic the exception or the rule? And are they going to change? As far as philanthropies, I think there's always need for demonstration of what to do. The federal government is a pretty risk-averse entity, and I don't think that a private philanthropy can provide childcare in perpetuity for all kids 6 months to 3 years old, which is probably what we would need, something kind of after the French system. But that doesn't mean that we don't need to know how that childcare should look, right? How big should the class sizes be? What kind of credentials do the instructors need? How close does it need to be to people's homes? Like, there's all kinds of demonstration questions that can be answered in a small scale and then brought back to a larger one. So no, you can't pay for childcare for Americans. I think that's the federal government and taxpayer responsibility. But there is a lot of room to influence what this recovery looks like based on what we've proven to work.
Kathryn, this was so fascinating. I personally learned so much, and I'm so grateful to you for sharing your expertise and your ideas with us. So thank you so much.
Yeah, it was a pleasure.
And thank all of you for joining us today. We hope you'll continue to stay connected to RAND and to the research that is helping decision makers navigate today's challenges and prepare for those on the horizon. Feel free to reach us at randremote@rand.org. I hope you'll join us again for the next RAND Remote conversation. Until then, stay well.